Hello, everyone, and welcome back to Mastering Finance with Dean Tellone. I'm your host, Dean Tellone, and I'm thrilled to have you join me for episode 4. In today's episode, we're diving into tax planning strategies, how to reduce liabilities and save more. Let's face it, nobody enjoys paying more taxes than they have to. The good news is that with some smart tax planning, you can legally reduce your tax liability and keep more of your hard-earned money. Tax planning isn't about evading taxes. It's about understanding the rules and using them to your advantage. In fact, the tax code offers many incentives to help people save for retirement, invest in their businesses, and support their families. Our goal today is to make sure you're taking advantage of those opportunities. Whether you're a working professional trying to maximize your paycheck, a parent looking to save for your kid's future, a small business owner aiming to cut costs, or an investor planning your next move, there are strategies here for everyone. I'll be breaking down key tax-saving techniques for individuals, families, business owners, and investors alike. And don't worry, we'll keep things simple and jargon-free so it's easy to follow along. So grab a cup of coffee, get comfortable, and let's jump in. By the end of this episode, you'll have a toolkit of ideas to help you reduce your tax liabilities and save more. Ready? Let's get started. Tax strategies for individuals and families. Let's begin with strategies for individuals and families. These are tips that can benefit working professionals, parents, and really anyone who earns an income. The goal here is to take advantage of every opportunity to lower the amount of income that gets taxed. 1. Maximize retirement contributions. One of the most effective ways to reduce your taxable income is by contributing to tax-advantaged retirement accounts like a 401k or a traditional IRA. The money you put into these accounts is often pre-tax, meaning it doesn't count as income for this year. For example, if you contribute $5,000 to your 401k at work, then $5,000 of your salary is not taxed this year. You're essentially paying yourself instead of the IRS. Over time, this can add up to big tax savings while also building your retirement nest egg. For instance, take Jane, a 35-year-old marketing manager. She decides to increase her 401k contributions at work. By the end of the year, she's put in $10,000. If she's in roughly a 22% tax bracket, that could save her about $2,200 in federal income taxes. And as a bonus, her company matches a portion of her contributions, which is free money toward her retirement. It's a win-win. Lower taxes today and more savings for the future. 2. Take advantage of health savings accounts, HSAs. If you have a high deductible health insurance plan, you might be eligible for an HSA. Contributions to an HSA are tax deductible or pre-tax if made through your payroll. The money grows tax-free, and withdrawals are tax-free when used for qualified medical expenses. It's a triple tax benefit. Imagine Sam, who has a high deductible health plan. He contributes $3,000 to his HSA this year. That $3,000 is not counted in his taxable income. A few years down the line, he uses that money for an unexpected medical bill, and he pays no taxes on those withdrawals. In essence, HSAs let you set aside money for health care and get a tax break both when you put it in and when you take it out for medical needs. Even if you don't have big medical expenses now, the money can stay invested and grow for future healthcare needs, even into retirement. 3. Claim all eligible tax credits and deductions. Tax credits and deductions are your friends because they directly reduce your tax burden. A deduction reduces the amount of income you're taxed on, while a credit reduces your tax bill dollar for dollar. Make sure you're taking the larger of either the standard deduction or your itemized deductions. The standard deduction is a flat amount everyone gets. It's quite generous, so many people won't need to itemize. But if you had major expenses like high medical bills, large charitable donations, or lots of mortgage interest in a year, itemizing could save you more. Beyond that, look at specific credits you might qualify for. For example, families with children can benefit from the child tax credit, which directly cuts your tax bill, currently up to $2,000 per child under certain conditions. If you paid for childcare so you could work, there's the Child Independent Care Credit that can offset a portion of those costs. And if you or your children are in college, education credits like the American Opportunity Credit or Lifetime Learning Credit can help with tuition and fees. Let's say Lisa and Mark have 2 young kids in daycare. Mark's employer offers a dependent care FSA, so they set aside pre-tax dollars to cover part of their daycare costs, and they also claim the child care credit for additional expenses. By using both a workplace benefit and a tax credit, they're able to save a couple of $1,000s on taxes while covering their child care bills. The key is to be aware of these credits and deductions. They're essentially the government's way of encouraging and helping with common life expenses, so take full advantage if you qualify. 4. Use tax advantage savings for education or other goals. If you have a goal like saving for a child's college education, consider using a 529 college savings plan. While contributions to a 529 aren't federally tax deductible, the money you invest grows tax-free and won't be taxed when used for qualified education expenses. Some states even give you a tax deduction or credit for contributing. Over 10 or 15 years, that tax-free growth can make a big difference in your college fund. Similarly, if you're saving to buy a home or for another major goal, look into whether there are tax-advantaged ways to do it. For example, first-time homebuyers can withdraw from an IRA up to a limit without the usual penalty to put toward a down payment. You'd still pay taxes on a traditional IRA withdrawal, but no penalty. The main idea is, if there's a savings goal with a tax-advantaged vehicle, use it. It'll help you reach your goal faster and with less tax pain. 5. Manage your withholding and filing status. This tip is more about avoiding surprises and optimizing your cash flow. If you're an employee, take a look at your Form W-4, the form that tells your employer how much tax to withhold from your paycheck. If you consistently get a large refund every year, it means you've been having too much tax withheld from your pay. You could adjust your W-4 to have a little less taken out, which would give you a bit more in each paycheck throughout the year. Essentially, you get your money now rather than waiting for a refund. On the other hand, if you always owe money and get hit with penalties, you might need to increase withholding or make estimated tax payments. Also, be mindful of your filing status. Most married couples file jointly because it usually results in a lower tax bill. But in certain cases, like if one spouse has a lot of medical expenses or other deductions tied to their income or specific student loan situations, married filing separately could save money. It's rare, but worth considering if your circumstances fit. If you're unmarried but supporting a child or relative, see if you qualify for head of household status, which has a bigger standard deduction and lower tax rates than filing single. The bottom line, ensure you're in the optimal category and that you're not giving the government an interest-free loan of your money or underpaying and facing penalties. In short, for individuals and families, the strategy is to plan ahead and use the tools available. Contribute to your future, retirement, health, education, in ways that also give you a tax break, claim the credits and deductions you're entitled to, and be mindful of how you're handling your withholdings and filing. It might feel like doing a bit of extra homework, but the payoff is real money saved. Why leave that money on the table? Now that we've covered personal tax tips, let's move on to business owners who have their own set of opportunities and strategies. Tax strategies for business owners. If you're a business owner or self-employed, even if it's just a side hustle, you know that taxes can be a bit more complicated than for a typical employee. The flip side is there are many more deductions and strategies available to you. The key is to treat your business like a business when it comes to taxes. That means keeping good records and being proactive with planning. 1. Deduct legitimate business expenses. As a business owner, you generally pay taxes on your net profit, your income minus your business expenses. So the more valid expenses you have, the lower your taxable profit. Make sure you're deducting everything you're entitled to. Common deductible expenses include office supplies, equipment, rent for an office or your home office, internet and phone bills, business travel, vehicle expenses for business use, professional services like legal or accounting fees, advertising and marketing, and employee wages or contract labor costs. For example, consider Alex, who runs a small graphic design business. He brings in $80,000 in revenue and spends $20,000 on business needs, a new computer and software, a drawing tablet, some online advertising, and occasional client lunches. That $20,000 in expenses is deductible, so he only pays tax on the $60,000 profit. If Alex is in the 22% tax bracket, those deductions save him about $4,400 in income taxes, not to mention self-employment tax savings. By keeping receipts and tracking those costs, he significantly cuts his tax bill. The lesson: save those receipts and track your expenses diligently. Every dollar you deduct is a dollar that isn't taxed. Just ensure the expenses are ordinary and necessary for your business. A genuine business expense, not personal. If you ever get audited, you want to be confident that each expense had a business purpose. 2. Consider the home office deduction, if eligible. Many small business owners and freelancers work from home. If you have a dedicated space in your home that you use exclusively for business, for example, a spare room turned into an office, you can likely take the home office deduction. This lets you deduct a portion of your home expenses, things like rent or mortgage interest, property taxes, utilities, homeowners insurance, and repairs, proportional to the size of your office space. For instance, Maria is an online consultant who works out of a spare bedroom in her house. That room is 10% of the square footage of her home. She can therefore deduct 10% of her qualifying home expenses as a business expense. If her rent, utilities, and other home costs amount to $30,000 for the year, 10% of that is $3,000. So she gets a $3,000 deduction for her home office. If she's in the 24% tax bracket, that saves her about $720 in taxes. Not huge, but nothing to sneeze at either. The important rule here is exclusive use. The home office area can't double as your kid's playroom at night or a guest bedroom on weekends. It needs to be a dedicated workspace. The IRS does allow a simplified home office deduction, a flat $5 per square foot of office space, up to 300 square feet, if that's easier. One more note. If you own your home, taking a home office deduction could have a slight effect when you sell your house, potentially some depreciation recapture tax. But for most, it's not a big issue. Just something to be aware of and discuss with your tax advisor. 3. Choose the right business structure. The way your business is legally structured, sole proprietorship, partnership, LLC, S Corp, C Corp, etc., can have a significant impact on how much tax you pay. Many small businesses start as sole proprietors or single-member LLCs by default, which is simple, and all the profit just passes through to your personal tax return. But as your business grows, it might be worth exploring other structures. For example, as a small business corporation, S Corp, you can potentially save on self-employment taxes. In an S Corp, you pay yourself a salary, which is subject to payroll taxes like Social Security and Medicare. But any additional profit can be taken as a distribution, which isn't subject to those payroll taxes. This can save money, especially once your profits are more than what a reasonable salary for your role would be. To illustrate, let's say John's consulting business makes $150,000 in net profit as a sole proprietor. He pays income tax and self-employment tax, 15.3% for Social Security Medicare, on the whole amount. Now, if John were an S Corp making the same $150,000, he might pay himself a salary of $80,000, reasonable for his role, and take $70,000 as a distribution. He'd pay the payroll taxes on the $80,000 salary, but not on the $70,000 distribution. That could save around $10,700 in taxes. Of course, there are additional costs to running an S Corp, payroll, incorporation fees, possibly higher accounting fees, and the IRS watches that salary for reasonableness. The point is, once your business income grows, it's worth asking a CPA if a different structure could save you money. Similarly, if you have a C corporation, you're taxed at a flat 21% at the corporate level, but then profits taken out as dividends are taxed again on your personal return, double taxation. Some small businesses avoid that by not using C Corp, but there are situations, like if you want to retain earnings in the business or get certain benefits, where a C Corp can make sense. Each option has pros and cons. The key is to periodically review your business structure as your situation evolves. 4. Leverage business retirement plans. Business owners have access to some powerful retirement savings tools that double as tax-saving plans. Instead of, or in addition to, a personal IRA, you can set up a SEPI IRA, a simple IRA, or a solo 401k, depending on your situation. These plans allow for much higher contributions than a regular IRA. For example, a SEPI IRA lets you contribute up to 25% of your net self-employment income with a cap, but it's quite high, tens of thousands of dollars. Imagine you're self-employed and your business nets $100,000 in profit. With a SEP IRA, you might contribute roughly $20,000, 20% of your net profit, to your SEP IRA. That $20,000 is a tax-deductible business expense, and it goes into your retirement savings. In a 24% tax bracket, you just saved about $4,800 on your taxes for the year. A solo 401k, similarly, lets you contribute both as an employee and as the employer, allowing potentially even more if your income is high enough. If you have employees, you might consider a simple IRA or even a full 401k plan. Contributions you make for employees are deductible, and a retirement plan is a great perk to attract and retain staff. The big takeaway here is, if you're a business owner, don't overlook retirement plans. They can shelter a lot of income from tax and help you build wealth for the long term. 5. Employ family members or use fringe benefits when appropriate. This is a bit more situational, but worth mentioning. If you have a family business, employing your spouse or even your children can create tax advantages. For instance, if you hire your teenage child to help in the business, you can pay them a reasonable wage for the work they do. That wage is a tax-deductible business expense for you, and for the child, that income might be taxed at a much lower rate, or not at all if it's under the standard deduction. They could even use their earnings to fund a Roth IRA for themselves, starting their retirement savings early. There are specific rules and paperwork needed, so again, do it correctly. Similarly, consider fringe benefits. Certain employee benefits are deductible for the business, but not taxable to the employee. For example, if you as the business owner or your employees need health insurance, the premiums you pay are generally deductible. Offering benefits like health insurance, life insurance, or education assistance can sometimes provide tax benefits and make compensation go further for everyone. Each of these has its own rules, but they can be part of a smart tax strategy for a business owner. Before we move on, remember that good bookkeeping is crucial for all these strategies. Keep business and personal finances separate, maintain clear records of income and expenses, and consider using an accounting software or professional accountant. Not only will this make tax filing easier, but if you ever need to substantiate your deductions, you'll be ready. The bottom line for business owners is plan and be proactive. The tax code offers a lot of incentives for entrepreneurs, from deductions to special retirement plans, but it's up to you to use them. A bit of planning can save you a lot of money, which you can reinvest in your business or take home as profit. All right, now that we've talked about earning in business, let's discuss those of you who are investing your money. How can investors minimize taxes? 5. Employ family members or use fringe benefits when appropriate. This is a bit more situational, but worth mentioning. If you have a family business, employing your spouse or even your children can create tax advantages. For instance, if you hire your teenage child to help in the business, you can pay them a reasonable wage for the work they do. That wage is a tax-deductible business expense for you, and for the child, that income might be taxed at a much lower rate, or not at all if it's under the standard deduction. They could even use their earnings to fund a Roth IRA for themselves, starting their retirement savings early. There are specific rules and paperwork needed, so again, do it correctly. Similarly, consider fringe benefits. Certain employee benefits are deductible for the business, but not taxable to the employee. For example, if you as the business owner or your employees need health insurance, the premiums you pay are generally deductible. Offering benefits like health insurance, life insurance, or education assistance can sometimes provide tax benefits and make compensation go further for everyone. Each of these has its own rules, but they can be part of a smart tax strategy for a business owner. Before we move on, remember that good bookkeeping is crucial for all these strategies. Keep business and personal finances separate, maintain clear records of income and expenses, and consider using an accounting software or professional accountant. Not only will this make tax filing easier, but if you ever need to substantiate your deductions, you'll be ready. The bottom line for business owners is plan and be proactive. The tax code offers a lot of incentives for entrepreneurs, from deductions to special retirement plans, but it's up to you to use them. A bit of planning can save you a lot of money, which you can reinvest in your business or take home as profit. All right, now that we've talked about earning in business, let's discuss those of you who are investing your money. How can investors minimize taxes? Tax strategies for investors. If you're investing in the stock market, bonds, real estate, or other assets, it's not just about picking winners. It's also about investing in a tax-efficient way. Taxes can quietly take a big bite out of your investment returns. So let's look at how to soften that bite and keep more of your gains. 1. Prefer long-term investments, lower capital gains tax. When you sell an investment for a profit, you owe capital gains tax on that profit. But how long you held the investment matters a lot. If you owned it for over 1 year, it's a long-term capital gain and is typically taxed at a lower rate than your regular income. If you held it 1 year or less, it's short-term and taxed at your ordinary income rate, which for many people is much higher. So a simple yet powerful strategy is, when possible, hold on to investments for at least a year and a day to be safe before selling. For example, suppose you bought stock in a company and its value has increased. If you sell after 6 months and you're in the 24% tax bracket, you'll pay 24% tax on that gain. But if you hold on until past the 1-year mark, you might only pay 15% on the gain. So on a $10,000 profit, that's the difference between paying $2,400 versus $1,500 in tax, a $900 savings just by holding the investment longer. Of course, this doesn't mean you never take profits or that you should ignore other factors. If you have a good reason to sell earlier, say the investment outlook changed or you need the money, you might do so. But being aware of the timing can inform your decisions and potentially save you a lot in taxes over the years. 2. Use tax loss harvesting. This is a strategy especially useful in taxable investment accounts, not IRAs or 401ks. The idea of tax loss harvesting is to make the most of your losing investments by using them to offset your winners. If some investments in your portfolio have dropped in value, selling them locks in a capital loss. You can use that loss to offset capital gains from other investments you sold at a profit. And if your losses exceed your gains, you can use up to $3,000 of leftover loss to reduce your regular income on your tax return. Any losses beyond that carry forward to future years. For instance, imagine at the end of the year, you review your portfolio. You made $10,000 in gains from some stock sales, but another stock is sitting at an $8,000 loss. If you sell the losing stock, that $8,000 loss can offset $8,000 of your gains, meaning you'd only be taxed on $2,000 of net gain. If you had no gains at all, that $8,000 loss could knock $3,000 off your ordinary income this year, saving you maybe $600 to $750 in tax, depending on your bracket. And the remaining $5,000 loss would carry over to next year's taxes. It's a silver lining to making a bad investment. At least you get a tax break. One thing to beware of is the wash sale rule. If you sell an investment to claim a loss, you and your spouse can't buy the same or a substantially identical investment for 30 days before or after the sale. Otherwise, the loss is disallowed. In plain English, you can't sell a stock to get the tax loss and then turn around and buy the same stock right back. You'd have to wait at least 31 days or purchase something similar but not identical, like sell one tech stock and buy a different tech company, or sell a mutual fund and buy a different fund that isn't essentially the same holdings. Tax loss harvesting is a common year-end strategy for many investors and even automated by some investment platforms because it can save a meaningful amount on taxes. Third place, investments in the right type of account. Asset location. Not all investment income is taxed the same. Interest from bonds, short-term gains, and non-qualified dividends are taxed at ordinary income rates. Qualified dividends and long-term gains are taxed at lower rates. And some income, like from municipal bonds, can be tax-free. Asset location means you put investments in accounts where they'll be taxed most favorably. For example, if you have a mix of retirement accounts and regular taxable accounts, you might keep bonds, which throw off regular interest income, inside your IRA or 401k, where that interest won't be taxed each year. Meanwhile, you could keep stocks or stock funds that you plan to hold long-term for growth in your taxable account, since those will mainly produce lower taxed gains or qualified dividends, or no tax until you sell. Another example, real estate investment trusts, REITs, often pay high dividends that don't get the lower dividend tax rate. Those might be better off in a tax-deferred account. The principle is to shelter the most heavily taxed income inside tax-advantaged accounts. Additionally, always try to maximize contributions to tax-advantaged accounts for your investments. If you have room in an IRA, 401k, HSA, etc., consider investing through those first. That way, your investments can grow without the drag of annual taxes. Over the long run, the difference can be enormous. Think of it like two plants growing, but one gets nibbled by rabbits each year, taxes, and the other is in a protected garden. The protected one will flourish more. 4. Consider tax-friendly investments. Some investments come with built-in tax advantages. A prime example is municipal bonds. These are bonds issued by states, cities, or other local governments. The interest from muni bonds is generally tax-free at the federal level. And if you buy muni bonds issued by your home state, that interest can be tax-free at the state level as well. This is especially attractive if you're in a higher tax bracket. For instance, a 4% yielding muni bond might not sound exciting, but if you would have paid 32% in taxes on a comparable corporate bond's interest, that 4% tax-free could be equivalent to about a 5.9% taxable yield. Suddenly, much more attractive. Another example, U.S. Treasury bonds are taxable federally, but exempt from state income tax, which can be useful if you live in a state with high taxes. If you invest in stocks, be aware of qualified dividends. Dividends from most U.S. companies and many international companies, which get the lower tax rate, versus non-qualified dividends, like those from RATs or certain foreign stocks, which are taxed higher. This can influence which stocks or funds you hold in taxable accounts. For high net worth investors, there are also more esoteric options like opportunity zone funds, which let you defer and potentially reduce capital gains tax if you invest in certain designated areas, or investments that yield tax credits, like low-income housing or renewable energy projects. These are complex and definitely require research or professional advice, but they underline a theme. There are ways to invest that not only aim for a financial return, but also provide a tax return in the form of savings or credits. 5. Make the most of real estate tax benefits. Real estate is a common investment and comes with its own set of tax rules that can be very favorable. If you own rental property, you can deduct all the typical expenses associated with that property: maintenance, repairs, property management fees, property taxes, insurance, mortgage interest, etc. On top of that, you get to deduct depreciation, a fraction of the property's value each year to account for wear and tear. Depreciation is a non-cash expense. You're not actually paying that money out each year. You likely paid for the property up front or with a loan, but it can shelter a lot of your rental income from tax. It's not uncommon for a rental property to show a paper loss for tax purposes, even if it's actually cash flow positive thanks to depreciation. Now, when you eventually sell an investment property, the gain could be large and subject to capital gains tax, plus depreciation, recapture tax. This is where a 1031 exchange can come in. A 1031 exchange, named after Section 1031 of the tax code, allows you to swap one investment property for another and defer the capital gains tax on the sale of the first property. Essentially, you're saying, I'm not cashing out, I'm just moving my investment from property A to property B. And the IRS lets you postpone the tax. For example, Sarah owns a rental condo that she bought for $150,000 and could now sell for $250,000. If she sells outright, she'd have $100,000 in taxable gain, minus any selling costs or improvements. But Sarah plans to keep investing in real estate. She finds a small duplex for $300,000 that she'd like to own. She can use a 1031 exchange, sell the condo, and roll the $250,000 of proceeds directly into purchasing the duplex. By doing this, she defers paying tax on that $100,000 gain. That could easily save her $15,000 or $20,000 in taxes right now, which effectively gives her more cash to invest in the new property. 1031 exchanges have strict rules about timing and how the money is held during the swap. You need a qualified intermediary, etc. So you'd want professional help. But it's a powerful tool that many real estate investors use to grow their portfolio without being hampered by taxes at each sale. Eventually, if you cash out, you'll pay the tax, unless you keep exchanging until, say, you pass away and your heirs get a step up in basis, which could wipe out the gain for income tax purposes. But that's drifting into estate planning. The main point is, real estate offers a lot of ways to delay or reduce taxes, which helps you build more wealth over time. For investors of all kinds, the key takeaway is to be mindful of taxes whenever you make investment decisions. It doesn't mean taxes should drive every decision, but they shouldn't be an afterthought either. A little forethought, like holding an asset longer, or choosing one type of fund over another, or timing when you take gains or losses, can make a significant difference in your after-tax returns, which is what really counts at the end of the day. Now, we've covered a broad range: individuals, businesses, and investors. Before we wrap up, let's touch on two specific groups who often have some extra considerations: retirees and high net worth individuals. They overlap with what we've discussed, but there are a few unique strategies worth mentioning. Strategies for retirees and high net worth individuals. Tax planning doesn't stop once you retire, and it certainly doesn't go away if you accumulate significant wealth. In fact, for many retirees and high net worth individuals, tax planning becomes even more important to preserve your savings and income. Let's break this into two parts. For retirees, after a lifetime of saving, retirement is when you start drawing on those savings. And how you do that can affect how much tax you pay. A key strategy is to plan your withdrawals from retirement accounts in a tax-efficient way. If you have a mix of account types, traditional 401k IRA, which is taxable on withdrawal, Roth IRA, which is tax-free on withdrawal, and maybe regular taxable investment accounts, think about which accounts to tap first. Often, people in lower income tax brackets early in retirement, for example, before Social Security or pension starts, or before required minimum distributions kick in, might choose to withdraw from their traditional IRA 401k or even do Roth conversions. A Roth conversion means moving money from a traditional IRA to a Roth IRA and paying tax on that money now, so that later on, all the growth and withdrawals from the Roth are tax-free. Why do that? If you're in a low bracket now but expect to be in a higher bracket later, due to RMDs or other income, it can reduce the total tax you pay over time. Even if you don't do conversions, you might take just enough from your IRA each year to fill up the lower tax brackets, and then use Roth or savings for the rest of your needs. This way you smooth out your tax bill. Also, be very mindful of required minimum distributions, RMDs. Currently, at age 73, for those turning 73 in 2023 or later, due to recent law changes, you must start taking RMDs from traditional IRAs and 401ks. These RMDs are taxable, and the penalties for missing an RMD are steep. 25% of the amount not taken, though it can be reduced to 10% if you correct it in a timely manner. Mark it on your calendar when you reach your early 70s to ensure you take out at least the required amount each year. If you don't need the RMD money for living expenses, you have a great option to still avoid taxes on it. You can direct it to charity by doing a qualified charitable distribution, QCD. From your IRA, you must be 70 and a half or older to do this. The amount, up to $100,000 a year, that goes directly to a qualified charity counts as your RMD, but is not counted in your taxable income. It's a wonderful way for charitably inclined retirees to fulfill their RMD requirement and their charitable goals at the same time without taking a tax hit. One more thing for retirees: keep an eye on how your income affects other things, like the taxation of Social Security benefits or Medicare premiums, For example, if your income, including half of your Social Security, is above certain thresholds, up to 85% of your Social Security benefit becomes taxable. Or if your income crosses certain limits, you'll pay higher Medicare Part B and D premiums. This is called IRM-AA. Sometimes doing a bit of planning, like maybe delaying a big IRA withdrawal to a different year or spreading it over 2 years, can keep you under a threshold and save money in a roundabout way. So the name of the game in retirement is distribution planning. Decide when and how to withdraw from your various accounts in a manner that minimizes taxes over your entire retirement horizon, not just this year. For high net worth individuals, if you're fortunate enough to have a very high income or a large amount of wealth, you face some additional tax considerations that most folks don't, and you have access to some advanced strategies. Here are a few high-level ones. Each of these could be a whole episode, but I'll summarize. Charitable giving strategies. We've touched on some charitable tactics already, like QCDs for those over 70 and a half. High net worth individuals often incorporate philanthropy into their financial plans, not only for the social good, but also for tax efficiency. Large charitable donations can yield substantial tax deductions. Tools like donor-advised funds, DFs, allow you to donate assets, cash, stocks, even real estate or business interests, and get a deduction now, but distribute the money to charities over time at your discretion. This is great if you have a high-income year or a windfall. You can give, say, $50,000 to a DAF in 1 year and deduct it. Then grant $10,000 per year to your favorite charity over the next 5 years. Another tool, charitable remainder trusts, CRTs, where you place assets in a trust, get an immediate partial tax deduction. The trust can sell assets without immediate capital gains tax and provide you income for life or a term of years, and whatever's left goes to charity at the end. This defers tax and can provide an income stream. There are also private family foundations for the ultra-wealthy who want more control and a family legacy of giving, though those come with more costs and rules. The best approach depends on your goals and scale of giving, but it's clear that the tax code rewards generosity, especially for those with the means to give. Gifting and estate planning. High net worth individuals have to think about the estate tax, which currently, as of 2023, kicks in for estates over $12.9 million, double that for couples. But that threshold could drop in the future when tax laws change. To reduce the potential estate tax hit and to pass wealth to the next generation, there are strategies like annual gifting and trusts. Each year, you can gift up to a certain amount, currently $17,000 per recipient per year, to anyone without using up any of your lifetime estate gift exemption or having to file a gift tax return. It's a use it or lose it each year opportunity to slowly transfer wealth tax-free. If you have, say, 3 children and 5 grandkids, you could gift each of them $17,000 every year. That's 8 recipients times $17,000 equals $136,000 per year you remove from your estate. And if you're married, you and your spouse can each gift that amount, effectively doubling it to $272,000 per year out of your estate. Do that for 10 years, and you've shifted $2.7 million without any gift tax. For larger transfers, there are trusts. Irrevocable life insurance trusts, ILITs, to keep insurance proceeds out of the estate. Grant or retained annuity trusts, GRATs, to freeze and transfer future appreciation. Family limited partnerships, FLPs, to consolidate and gift interests at discounted values, etc. These are advanced tools and definitely require a good estate planning attorney and CPA to execute properly. But they can save millions in taxes for very wealthy families. Even if you're not ultra wealthy, if you expect to leave a sizable estate, a bit of planning can ensure more of your money goes to your heirs or favorite causes rather than taxes. Investment and business tax strategies. High net worth individuals often have complex investment portfolios and perhaps business interests. They might take advantage of things like tax-efficient borrowing, using a portfolio line of credit or margin loan against investments instead of selling and triggering gains when they need cash. Or deferment strategies if they're, say, selling a business, like structuring an installment sale to spread the gain over years, or using an opportunity zone investment, as I mentioned, to defer, reduce gains. If they have significant stock positions, they might use charitable stock donations, donate appreciated stock to avoid capital gains and get a deduction for the full value, or set up plans to systematically sell shares and manage the tax impact. For those with high incomes from their job or business, defined benefit plans or cash balance pension plans are sometimes used to stash away even larger pre-tax amounts than a 401k allows. And of course, they maximize everything we talked about for individuals: retirement accounts, HSAs, etc., even if those seem small in comparison, because every bit helps. A common theme at this level is also professional guidance. Having a CPA and financial advisor team who continually looks for tax-saving opportunities, be it harvesting losses, reallocating assets for better tax outcomes, or planning transactions in the most efficient way. I know that's a lot, and if you're listening and you're not near these thresholds, it might sound excessive. But the reason I cover it is to show that tax planning spans all levels of wealth. Whether you're making $50,000 a year or $5 million, the core idea is the same. Plan ahead and use the rules to your benefit. The difference is just in which tools are worth the effort. For most people, it's contributing to an IRA. For a billionaire, it might be setting up a complex trust. But both are forms of tax planning. For retirees and high net worth individuals, I'll reiterate the most important advice. Work with professionals who specialize in these areas. The stakes are high and the rules can be intricate. A good financial planner or tax advisor can craft a strategy tailored to your situation, and often the tax savings from proper planning will far outweigh the cost of the advice. All right, we have covered a lot of ground. From the average working professional to business owners, investors, retirees, and the very wealthy, we've discussed how almost everyone can benefit from some form of tax planning. To close out, let's recap with a few actionable takeaways that you can apply in your own life. Actionable insights. That was a wealth of information. To help you put it into practice, here are some actionable steps you can take right now to start implementing tax-saving techniques. Make tax planning a year-round habit. Don't wait until April to think about taxes. Mark your calendar for a mid-year tax check. For example, each June or July, and a year-end review, November, December. By planning ahead, you can still make adjustments, like boosting a 401k contribution, doing a Roth conversion, or making a big charitable donation before the year is over. Proactive planning gives you more control and options than last-minute reactions. Maximize tax-advantaged accounts. Take full advantage of accounts that give you tax breaks. Contribute to your 401k or 403b at work, at least enough to get any employer match. That's free money. If you're eligible, contribute to a traditional or Roth IRA each year. Use an HSA if you have a high deductible health plan. These accounts are foundational tax strategies for most people. Over time, consistently using them can save you tens of thousands in taxes and build your wealth. Keep good records. Documentation is key. Create a system for keeping track of tax-related documents and receipts. For individuals, this might mean a folder, physical or digital, for charitable donation receipts, medical bills, tuition payments, property tax statements, etc. For business owners, it means tracking all your expenses, mileage logs if you use your car for business, receipts for equipment, etc. There are apps and software that can make this easier. Even taking a quick photo of a receipt and saving it to a cloud folder can do the trick. Good records ensure you won't miss out on deductions and will make tax time much less stressful. Review your withholding and estimates. Check your paycheck withholding, or, if you're self-employed, your quarterly estimated tax payments. Ideally, you want to be pretty close to breaking even at tax time, owing a little or getting a small refund. Big swings either way mean you should adjust. A huge refund means you've been giving the government a free loan. You could have had that money in your pocket sooner, and a big balance due could mean you underpaid and might face penalties. The IRS has a withholding calculator on their website, or you can consult with a tax pro to dial this in. Adjusting your W-4 or estimates now can prevent headaches later. Educate yourself on relevant tax breaks. Take some time to learn about the tax breaks that apply to your situation. Are you a parent? Read up on child credits, dependent care accounts, and 529 plans. A homeowner? Understand what property taxes and mortgage interest you can deduct, or how they factor into your standard deduction. An investor? Know the basics of capital gains rules and any tax-efficient funds or bonds you might use. You don't have to become a tax expert. That's what professionals are for. But being aware of a few key points can help you make better decisions throughout the year. Plus, it empowers you to ask the right questions of your tax preparer or advisor. Be strategic with big financial moves. If you're planning something major, selling a home or business, exercising a bunch of stock options, retiring, etc., consider the tax implications before you do it. Sometimes the timing of a transaction, December 31st versus January 1st, or spreading a sale over 2 years, can change the tax outcome. Or the way you structure a deal, like taking installment payments for a business sale or doing a 1031 exchange for property, can save a lot in taxes. Before any big financial move, ask, what will this mean for my taxes? And can I do it in a smarter way? Consult a professional for complex situations. If your situation is complicated or you're just not comfortable navigating it alone, it's perfectly okay, in fact, very wise, to get professional advice. This could be a one-time meeting with a CPA or financial planner to review your situation, or ongoing help if you need it. Professionals can often spot opportunities or pitfalls you might miss. For example, they might notice you're eligible for a tax credit you didn't know about, or warn you that your income is nearing a threshold where a different strategy would be beneficial. Think of it like going to the doctor for a checkup. A tax professional can give your financial plan a checkup and keep it healthy. The money you spend on good advice can come back to you several times over in tax savings or peace of mind. Stay informed on tax law changes. Tax laws aren't set in stone. They change with new legislation and as sunset provisions expire. For instance, the tax cuts passed in 2017 are set to expire after 2025, which could change income tax rates and standard deductions, etc. Make it a point to stay informed, especially on changes that affect common things like retirement accounts or credits. You don't have to read the tax code, but when you hear of a new tax law, take a moment to see if any of the changes apply to you. This way, you won't miss out on new opportunities or get caught off guard. By following these steps and pointers, you'll be well on your way to keeping more of your money in your own pocket. You don't have to do everything at once. Even implementing 1 or 2 new strategies each year can make a noticeable difference. The most important thing is to approach your taxes proactively, rather than reactively. Conclusion: tax planning might not be the most glamorous part of finance, but it is absolutely one of the most impactful. Remember, It's not about what you make, it's about what you keep. By using the strategies we talked about today, you can legally and ethically reduce your tax liabilities and direct those savings toward the things that matter to you, maybe bolstering your retirement fund, growing your business, investing for your future, or simply having extra money for your family and hobbies. Let's quickly recap the big picture. Be proactive and plan ahead. Contribute to retirement and savings accounts that give you tax benefits. Keep track of your eligible deductions and credits each year. If you run a business, take advantage of the deductions and plans designed for entrepreneurs. If you invest, remember that the way you invest can be just as important as what you invest in when it comes to taxes. And for those in retirement or with significant wealth, plan your withdrawals and estate moves carefully to minimize taxes over the long haul. Everyone's financial situation is a bit different, which means the best tax strategies for you might differ from your neighbors. That's why, as we've emphasized, consider seeking out professional financial or tax advice for your specific circumstances, especially if you heard something today that made you think, I wonder if that applies to me, or how exactly I would do that. A licensed tax advisor or financial planner can customize these strategies to your life and goals. Don't hesitate to reach out to an expert. Even a 1-hour consultation can provide clarity and potentially save you a lot of money. Thank you for joining me on this deep dive into tax planning. I hope you found this episode informative and empowering. Taxes can often feel like a burden, but with the right strategies, you can turn them into an opportunity to keep more of your money and use it to build the life you want. If you enjoyed today's show, please subscribe to Mastering Finance if you haven't already, and share this episode with friends, family, or colleagues who might also find it useful. We're all about spreading knowledge and helping others achieve financial success. Feel free to send me any questions or topics you'd like to see covered in future episodes. I love hearing your feedback and ideas. Until next time, this is Dean Tellone signing off. Happy financial planning. And remember, it's not just about how much you make, it's about how much you get to keep. Take care, and see you on the next episode.